Welcome back to the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Hamoen. In this episode, we're diving into the latest developments in Canadian real estate and the economy. From immigration cuts affecting housing prices to the Bank of Canada's recent moves, there's a lot to unpack. So let's get started. Our top story of the week comes from a recent report by BMO, one of Canada's oldest banks, which suggests that Canadian real estate prices are set to correct following significant cuts to immigration. According to BMO, Canada has a housing demand problem rather than a supply problem. This new direction from the Government of Canada to reduce its population could signal the first real steps toward stabilizing the housing market. In the coming years, this population decline is expected to lower shelter costs, particularly rents, making housing more affordable for Canadians. In a surprising twist, the Canadian government announced a shift in its immigration policy, moving towards actual net reductions in population rather than just a slowdown. This decision was unexpected, especially given the previous stance of labeling such measures as xenophobic. However, it seems this move was more about saving face, as demand to immigrate to Canada has significantly dropped. It's akin to the government firing someone after they have already quit. On the economic front, the Bank of Canada has made a bold prediction. Following a recent rate cut, the central bank is optimistic about the economy, forecasting that real gross domestic product will receive a substantial boost from the aggressive easing measures they've adopted. The Bank of Canada's forecast suggests housing demand could see a resurgence akin to the record surge of 2021. They anticipate that nearly a quarter of all real gross domestic product growth next year will stem from real estate investment. However, with a declining population now expected over the next 2 years, these are indeed optimistic assumptions. Interestingly, the Bank of Canada's decision to implement a supersized rate cut has raised eyebrows. Traditionally, central banks aim for slow and controlled policy changes to maintain stability. This double cut in October signals the Bank of Canada's urgency to address deflationary pressures such as rising unemployment and a slowing population growth. The timing of this cut, just before the government's announcement to reduce immigration, raises questions about the central bank's independence and its coordination with government policies. RBC, the largest bank in Canada, has issued a warning that the rising unemployment rate poses a greater risk to the economy than the so-called mortgage renewal cliff. Over the past 2 years, there have been concerns that mortgage renewals at higher rates would severely impact the economy. However, RBC suggests that the real threat now comes from increasing unemployment rates, which could have more significant economic repercussions. Despite falling interest rates, Canadian household debt growth is slowing down. By August, households owed an enormous $3 trillion in debt, yet the growth rate of this debt is unusually low compared to historical trends. Much of this debt is concentrated among a small segment of households, while lower income and younger households remain largely excluded from the housing market. Until home prices or incomes adjust, these groups are unlikely to drive credit growth significantly. That's all for today's episode. Thank you for joining me on the Ontario Mortgage and Real Estate Insights podcast. If you found this episode insightful, be sure to subscribe and share it with others who might find it useful. I'm Steve Hamoen, and I look forward to bringing you more updates and expert insights in the next episode. Until then, take care and stay informed.